These stocks have had an incredible run-up in these sectors. Is there anything that could be said tonight that would cause this run-up to stall?
Yeah, that's a good question, and I think that a lot hinders on the specific details that he gives. Right now, people are maybe starting to get a little tired of sort of the vagueness of what he's been saying. If you look at the infrastructure trade, that was one of the hottest trades in the stock market up until a couple weeks ago. It's since kind of come down a little bit, and then yesterday he sort of reinflated it by saying that he was just going to spend big. He didn't really give any details, but people are piggybacking off that and buying stocks, assuming that maybe he will follow that up with a comment tonight with maybe a little more detail, perhaps a dollar amount or a timeline. And then one thing that could actually cause the stocks to go down is if there's any sign that the timeline is going to be delayed at all. If these measures that people expected in 2017 are actually going to be in 2018 or even further down the line than that, that could definitely be something that would weigh on them. And we have seen that for certain areas that have been stalled.
We have certain details already. It's not like Trump has given no details. We have the $54 billion amount. We have a 10% amount. Mm-hmm. We know that Obamacare is going to get taken care of before taxes. So there are certain things that we know. What will investors be looking for? Trump comments or the reaction of GOP congressmen and senators?
Yeah, well, the Trump comments are really, that's the headline risk. That's what's going to cause futures to move tonight. That's what's going to cause them, it's going to determine where the market's going to open tomorrow and which sectors are going to be leading the way. One thing that people are going to be paying really close attention to is any sort of guidance on tax reform, whether that means just the corporate tax rate being lowered to around the 15%, which is what he's proposed from the 35% where it currently is, and also the repatriation tax for companies holding cash overseas, lowering that all the way down, which is expected to help, in particular, tech companies.
Which stocks, which sectors, Paul, as I look at the Stock 600 since Trump's victory, every industry group, all 19, rising, led by basic resources, tech, autos, industrial goods and services, healthcare. Which industry groups are most liable to move on the back of Trump's talk later?
Yeah, well, what I think is interesting in Europe, obviously the miners have done particularly well because of the expected spend to build everything. You need to pull more materials out of the ground. It leads to the inflation trade and stuff like that. That's good for banks as well. It raises or steepens the yield curve, means they can make money from maturity transformations. I think one of the ones that we really want to watch out for in Europe, though, is defense companies. They're kind of hidden in among other industry groups, including industrials. And then obviously healthcare is something that's reacted to some of the Trump comments before.
Among your wonderful conversation on Markets Live today was commenting on just that, defense spending and the spillover to national budgets. And you cite a Barclays piece, Achilles heel of the euro area. What's the flip side of Trump spending so much on defence?
I think this is really interesting thing to look at going forwards. Trump obviously is spending more on defence, and he's encouraging the euro area nations, and in fact all countries in NATO to spend more, or at least to come up to the 2% of GDP spending target that's kind of underscores the NATO agreements. A lot of the euro area nations are currently way short of this, and surprise, surprise, it's those that are trying the hardest to control their deficits, the ones that have the highest debt. We're looking at Italy, we're looking at Spain, we're looking at Portugal. Barclays has some astonishing figures on how much actual money it would come down to them having to invest to come up to this target, somewhere close to $100 billion, or 0.7% of GDP for those countries. I think, that would obviously send a lot more money into the defense companies, but it would also challenge the debt levels, the debt sustainability, and the appetite of bond investors for debt from those higher deficit nations.
Joe, you've written this great piece and you've highlighted the sectors, financials, retailers, building, engineering, healthcare, companies with high tax rates. Interesting, something you highlighted, fund managers are still underweight the financial sector, aren't they? So the potential exists for more gains.
Yeah, that was something that floated by Savitha Subramanian from Bank of America Merrill Lynch. And yeah, that's a really good point. And what we're seeing there is it's all about the deregulation of Dodd-Frank and sort of scaling back these measures that are kind of put in place to make banks more transparent and as a byproduct maybe a little less profitable. So people are really piggybacking on that. And then also you can't really ignore the rate hike story. Banks have long been figured to be the sector to benefit most from higher rates, and so that some of that can be attributed to Janet Yellen. It's not all Trump doing this for financial stocks, but yes, as Savita from Bank of America says, more room to run in banks. So that'll be a really good area to keep a close eye on tonight.